afternoon, Low VA Rates Nation. Hey, thanks for hanging out with us again on a Friday afternoon. It's a great summer. It's hot, but it is not Middle Eastern hot yet today here in Utah. So our topic is, for a Friday afternoon, the difference between an FHA, a VA, and a USDA loan. All of these are government-backed products that American citizens can take advantage of to purchase a home or maybe do a refinance. So we're going to look at some of the nuances for these today. We're going to look at maybe the loan to value for purchase loans. So take a look at it. On a USDA loan, you can actually finance up to 100% of the value. FHA, you can do 96.5%, and VA is also 100%. So what that means is on a $200,000 house, you're looking at, you don't have to have any down payment money for either a USDA or a VA loan. But on an FHA file, you'd have to have about $7,000 in savings just for your down payment on that loan. It may take you a while to save that much money. The other thing is we look at the loan amount. You know, how much purchasing power can you release or use to purchase a home? So USDA loan, you can go up to that conforming loan amount limit of $424,100. FHA is county specific. So each county throughout America has a county limit for FHA loans. For example, if you're from the great state of Nebraska like I am, you're going to have a lower county limit because it's rural America than, for example, if you do here in the metro area of Salt Lake City. On a VA loan, you can actually do greater than $424,100. Remember last week we spoke about the power of a jumbo VA loan, still comes into play today. Some of the other things we're looking at is your credit criteria that we have for these, so also known as the infamous Fico Score. The USDA loans has a 640 requirement. FHA has a lot of lending institutions that are around that 680 mark, and VA does not have a stated specific FICO score, but in the mortgage business, everything is priced according to risk. So there's some risk factors that do come in regarding what your FICO score might be. And some of those are, have you had a prior mortgage? Have you had any credit lates in the last 24 months? Do you have a bankruptcy or a foreclosure that's out there? So when you're looking at using your VA benefits to purchase a home, my advice, as always on Friday afternoons, is please pick up the phone, call one of our low VA rate specialists here at Low VA Rates so we can talk to you about how you can use that VA benefit. Some of the other things that we look at are the debt to income ratios. That means how much of your income each month goes towards your mortgage payment and all of your other debts. So the USDA loan's kind of restrictive. You've got 28 and 36%. A VA loan is at 31.43. And then a VA loan has its own unique criteria called residual income. Remember, the veteran loan for American veteran has been around since 1946 and never required a cash infusion from the American people. This residual income requirement is based on family size by geographic area. For example, a family size of 4 in the southeast is going to have a lower residual income requirement than a family of 4 in northeast America because of the difference in cost of living factors. Again, you've got more power with the VA loan here. One of the other areas that we want to look at, or the last area, is what is your mortgage insurance? And I have to tell you this, mortgage insurance is for civilians. Those that have not raised their right hand, swore an oath to defend the Constitution of the United States, get to pay mortgage insurance. On a USDA loan, say you're at that $200,000 purchase price that we used here, you're going to have a $2,000 fee for that, plus $58 per month. If you're doing it on an FHA file, it's going to be $3,500, and the fee a month goes up to $141.66. So each month you're giving Uncle Sam another $141.66 out of your net paycheck, because I already took a chunk for taxes to begin with. So when we come down here to the VA loan, they have a VA funding fee unless you are a 10% or greater rated disabled veteran from your military service. That waives your VA funding fee. For example, a 10% disability rating on a $200,000 loan here saves you $4,300. So you're looking at quite a bit of savings. And remember, veterans do not have to pay a monthly mortgage insurance premium in conjunction with their VA loan. The VA loan has more flexible credit criteria than the other two. They have a larger loan amount because you can go over the 424. They don't have county restrictions. And remember, if you're looking at a USDA loan, they have county income limits. You have to be at the median income for that county that you're looking to purchase in, either as an individual or a joint family. Again, the VA loan that we love and adore here at low VA rates is the preferred option for all veterans to take advantage of to buy a home. If you're looking at a refinance transaction, a USDA loan, you're just going to refinance the balance, not take any equity out. FHA will allow you to go up to 85% of the value of your home, and you can take cash out. But remember, you're still going to come back with that upfront MIP and your monthly. But a VA loan, you can do up to 100% of the value of your home. And as a veteran, that's very powerful. You can pay off some debts, pay for some college education for your children. Hopefully you don't have to pay for any unsuspecting weddings, but if you do, you know you can use that cash for it. Before I wrap up today's Friday, Red Friday moment, do we have any questions that we've got to answer, Lance? We're all good? Thank you again, Low VA Rates Nation. Have a safe holiday weekend. We're at the end of the 4th of July week. Stay safe, drink water, and I'll see you next Friday.